Dr. Phil here. This is a video on accounting for long-term liabilities. So we're basically going to split this chapter up into two sections. The first is talking about bonds, which really is just a type of loan, and then we'll talk more about long-term loans. All right, so bond financing. So before we kind of get into this, let me just explain just a little bit about bonds that you may or may not know. Like I said, a bond is just a loan. Companies want to do all these things. They need money. They don't have it, so they issue equities, right? They issue stock, but they may also issue bonds. So if you buy a bond, you're basically loaning the company money, right? And they're paying you interest, just like the bank loans you money. You're loaning the company money, and you're receiving interest payments. And then at some point, it could be 5, 10, 20, 30, 40. I've seen up to seven. I've seen 70-year bonds. Just depends on how long the bond is good for, and then it's going to end, and you're just going to get your money back. And that's kind of the macro idea of a bond. So the corporation pays, as we can see here, pays interest payments typically semi-annually to its investors. Um, and then like if you look at the sort of the timeline here, the bond issue date, and then there's going to be a whole bunch of interest payments. The interest payment is just calculated as whatever they use the term par value, which just means what was the bond for. So if you bought a bond for 10 grand, the par value would be 10 grand. That's it. Multiplied by the contract interest rate, and then multiplied by the time. We'll see some examples of those shortly. So advantages and disadvantages, pros and cons of bond financing. So there's some advantages. Bonds do not affect owner control. It's not like buying stock where, you get a small, albeit small ownership in the company. Bonds aren't like that. You don't get any ownership. You're just basically lending them money. They're paying you interest. Now it is contractual. Interest on bonds is tax deductible, which is a huge advantage. Bonds can also increase return on equity, and think about why. Because by issuing bonds, they're not issuing as much stock. So, it's like if we were going to issue just like stock, let me get this in the camera so you can see it. There we go. Then we could, imagine you've got this much stock. But if you're like, well, we'll do stock and bonds. So we only need to issue this many bonds. So instead of saying having, a million shares outstanding, we're going to issue bonds and we'll only have, say, 100,000 shares outstanding. So therefore, because there's just less equity out there in the form of common stock, or preferred stock, then that's going to just simply by diminishing the number of shares, it's gonna automatically increase return on equity. What about disadvantages? So we know that bonds require payment of both periodic interest and par value at maturity. So, and it is contractual. So companies, and these are often for a long period of time. So companies have to make sure, guys, we got to make sure we can pay this, even in downturns because it's contractual. And of course, bonds can technically also decrease return on equity. So again, depending on what the balance is, between the number of bonds you issue and the number of shares of stock. So bond trading, you can kind of read these in the some of like the London Times, the Wall Street Journal, these kind of financial broadsheet tabloids. So bonds are securities that can be purchased or sold in the securities markets. They have a market value which is expressed as a percent of their par value. So like in this one, 103.08, it's basically trading for 3.08% above its par value. The closing price indicates that the IBM bond, this is the one you see here, is being sold at 103.08% of face value. So it would be selling at a premium. I'll come more about that later. So issuing bonds at par. So on the issue date, let's take a look at an example. This is fairly straightforward. So on December 31st, 2021, a company issued the following bonds. So par value was 100 grand. Stated interest rate was 8%. And the interest dates were last day of June and the last day of December. Like I said, semi-annually, typically following a calendar year. And then the maturity date is December 31st, 2023. So this is 2 years. You won't generally see a bond for 2 years. You don't tend to see them for less than about 5. So we have, the company is going to debit cash. Think about why. They're selling you the bond. What are you giving them in return? You're giving them money. So they're going to increase their cash. Cash, of course, is an asset account, normal debit balance. And then they're also going to increase the liability account bonds payable in the amount of 100 grand. So it's like saying the company says, hey, we got 100 grand cash. We also now owe 100,000 in bonds, but we got to pay back at some point. So issuing bonds at par. So let's look at an example of that. So on June 30th, 2022, the issuer of the bond pays the first semi-annual interest payment of 4 grand. So this is where they're going to debit bond interest expense. They're going to increase the expense account and they're going to credit cash. So cash is going to go down because they're paying money out. They're increasing their bond interest expense. So it's 100,000 times 8%. So if you were doing that on a calculator, make sure you don't put in 0.8. That would be 80%. Hey, if you can find a bond that pays 80%, you let me know. We'll definitely get in on that one. So just make sure you put it in as 0.08, right, to get 8%. So 100,000 times 0.08 times, it's just you to do 1/2, or you can just decimalize it as 0.5 if you don't want to use a fraction, and you'll get the 4,000. So this entry is made every 6 months until the bond matures. So think about like 100,000 times 8%. So it's really 8,000 a year, but because they're paying it semi-annually, it's 8,000 divided by 2, and there is your 4,000. So what about a maturity? So if you remember, this was only a 2-year bond, which, like I say, is pretty unusual. On December 31st, 2023, the bonds mature and the issuer of the bond pays face value of 100,000 to the bondholders. So now it's just going to be the exact opposite of if we go back to that first entry right here, notice this is when they took it out. Debit to cash, credit to bonds payable. Now it's just the other way around, right? Now it's a debit to bonds payable. They're removing it. That's a liability account, right? Normal credit balance. You want to lower it, so it's a debit. And then cash, of course, is an asset account, normal debit balance. You want to decrease it, so it's going to be a credit because they're having to pay the cash back out now. So bonds don't typically sell at par. That's fairly unusual. They're typically going to sell for a discount or a premium, depending on the rate of the bond versus the market interest rates. So as you can see here, the bond sets the contract rate, and then the market is going to obviously set the market rate. So if we look at these bond price determinants, so if the contract rate is greater than the market rate, the bond sells at a premium. What you're basically saying is the market's paying this, our bond is paying this, so people are willing to pay more to get the higher interest rate. The example we just looked at was the par value, where the market rate is the same. If it sells at par, which, by the way, bonds are typically sold in denominations of $1,000, $1,000. If par equals, if it sells at par, then it's just going to sell for the $1,000 typically. And then if the contract rate is less than the market rate, then the bond would sell at a discount. So the idea here is that if the market's paying, say, 10% and our bond is only paying 8%, then we've got to give a discount, right, in order to incentivize people. Otherwise, investors are going to say, why on earth would I buy your bond for 8% when the market's paying 10? Help me understand that. So, but what we do is we lower the price of the bond. We're basically giving a discount, and the discount is equal to the interest rate differential. So as an example of a discount bond, so it says FILA issues bonds with the following provisions. So 100,000 par value. The issue price was 96.4. So obviously, again, it's less than 100, so we know it's a discount. Stated interest rate is 8%. The market rate is 10. So again, just between those two rates, the interest rate for our bond, or FILA's bond, I should say, is lower, so it's going to be a discount. So the interest dates are the end of June and the end of December. The bond date is December 31st, 2021, and the maturity date is 2 years thereafter. So on December 31st, 2021, FILA is going to record the bond issue. Now, what they're going to do here is they're going to record the par value at 100,000. But the cash proceeds, they're only going to get 96,400, right? And that's coming from the 96.4. If I go back real quick, issue price, 96.4%. So you can just do 100,000 times 96.4%. So the discount they're giving is 3,600. So they're basically lowering the price by 3,600 to incentivize people to buy. So you can see here, they're going to debit cash, 96,400. They're getting 96.4. They're going to record a debit to an account which they're going to set up called discount on bonds payable, 3,600. And then they're going to credit bonds payable in the amount of 100,000. And the reason is because they're actually going to pay back, they're going to have to pay back that 100,000 at the end of the term, end of the 2 years. And here is the balance sheet presentation. So you can just see long-term liabilities. You can see it says bonds payable, 100,000. Less the discount of 3,600. So what we call the carrying value, kind of similar to like the book value of assets. The carrying value is 96,400. And then as far as the interest goes, four payments of 4,000. And then you can see here, it's just the 100,000 multiplied by the 0.08. That's the, remember, it's 8% interest, and then it's being paid just over half a year. So there's your 4,000. Now it's for 2 years, right? So they're basically going to make the first year, they're going to make two payments of 4,000. The second year, they're going to make the other two payments. So it's 4,000 times four, two in the first year, two in the second. There is your 16,000. And then we've got the discount of 3,600. That's going to give us our total bond interest expense. So let me just circle back to the discount real quick. You notice that they're including the discount as an expense. The reason they're doing that is because the company is basically losing the 3,600 because they had to give a discount. So in that sense, they only sold it for 96.4, but they're going to have to pay back 100. So that 3,600 represents a cost to the company. That's why they're including it as part of the expense. So the bond interest expense per period is really not just what they're paying out, that's like these four payments of 4,000, it's also the discount. So we're basically going to factor that in, and then we're just going to divide it by four, and then we get $4,900 per period. So bond interest expense is debited for the 4,900, and then discount on bonds payable is going to be 900, and then we know that the cash being paid out is 4,000 twice a year for 2 years. And then the difference between the 49, the overall expense, and what they're actually paying out is basically the amortization of the bond discount. So this is just, you can pause this if you want, take a kind of a cursory look over this. This is kind of how this is being amortized out, right? So we know we started with 3,600, and then 900 was basically amortized back, right? So the carrying value increases again, and then finally. So what we're doing is every year we're just slowly increasing the carrying value, right? 3,600 bucks. So we've got to go from 96.4 up to the 100,000, and we're doing it by 900 bucks each period. So the goal is at the end of the 2-year term, right? 12/31/2023, that's in bold. The carrying value has been increased to 100,000, and that's what we're going to pay back. So what about premium bonds? So let's assume that Adidas issues bonds with the following provisions. So again, par value 100. Now notice now that the issue price is over 100%. So straight away, you're like, oh, okay, this is selling at a premium, 103.6%. Stated interest rate is 12%. The market's only paying 10. So again, Adidas bond is paying 2% more than the market. So again, we know it's going to be selling at a premium. Same interest dates, and then the same 2 years. So on December 31st, they'll record the bond issue as, so the first thing we'll do before we talk about the journal entry, we'll talk about this. So the par value is 100. They're actually going to get 103,600. So therefore, the premium is 3,600. So the company, as far as like putting it into the journal, putting it into the books, they're going to debit cash, increase cash for 103.6. They're going to increase bonds payable for 100,000 because again, that's what they're going to pay back at the end. And then the difference between the two is going to be a credit in this case to premium on bonds payable because we want to increase equity in the amount of 3,600. And then here you can just see the balance sheet presentation. So if you were looking at Adidas balance sheet, it would be like, okay, bonds payable 100 plus the premium 36. So the carrying value is 103.6. And what we're actually going to do now is we're going to actually lower the carrying value down to the 100. So let's get to that. So this is how we do it. So the first thing we'll do is we're going to note that Adidas are going to make they're going to make the following entry every 6 months to record the cash interest payment and also the amortization of the discount. So it's kind of like what we just did before for discounts. It's just kind of the other way around. So there's four payments of 6,000. Four payments, right? 100,000, 12% interest, but it's 6,000 twice a year, so 24,000. Less the premium of 3,600, so that's basically being taken away from their expense. It's like saying, hey, we're going to pay 24,000 out, but we sold it for an extra 3,600, so that's kind of taking away from our overall expense. We'll pay out 24,000, but we're like, wait, we did get an extra 3,600 when we sold it, so our total interest expense is basically our net expense is 20,400. We'll just divide that by the number of periods. Again, 2-year bond, 2 payments every year. There's your 4. We're going to have a 5,100 expense each period. So they're going to debit bond interest expense to increase that for 5,100. They're going to credit cash for 6,000 because at the end of each 6 month period, and there's four of them, they're going to pay out 6 grand. And then the premium on bonds payable is just going to be the 3,600 divided by four. So that's pretty much it for premium bonds. Here you can see the amortization. So again, now like with the last one, it was 3,600 under. Now it's 3,600 over. So they're just basically taking the carrying value from 1,036 over those four periods down to 100,000 because that again, that at the end is what they've got to pay back to the bondholder. So look at bond retirement again. It's kind of like issuing the bonds. This journal entry is pretty simple. So retirement of the FILA bonds at maturity for 100,000 cash. They're just going to do the opposite. They're just going to debit bonds payable. Again, that's a liability account, normal credit balance. We want to remove it, so it's done with a debit. And then they want to credit cash because, again, cash asset account, right? Normal debit balance. Do you want it to go up? No. Cash is going out. We want it to go down, so we're going to credit in the amount of 100,000. So what about bond retirement before maturity? So you might say, well, why would that happen? Why would they do that? Well, that can happen because companies maybe if they get like a capital infusion, if they get money coming in, it's kind of like you. If somebody sent you a check for your birthday, let's say like your grandmother or your great aunt sends you $5,000 for your birthday, and you're thinking, well, I wasn't expecting this money. I'm gonna go pay off my car loan. Why would you do that? Because you can save yourself all the future interest payments. So this is sort of akin to, why companies would pay off debt early because they can save themselves future interest. So if the carrying value at the time of retirement is greater than the retirement price, the company's going to have a gain. And then if it's less than the retirement price, they're going to have a loss. So let's look at an example of that. So assume that 100,000 of callable bonds will be retired on July 1 after the first interest payment. The bond carrying value is 1,045, and the bonds have a call premium of 3,000. So really just a question of just putting this into the journal. So the first thing they're going to do is debit bonds payable. They're just removing the bonds payable because they're getting paid off. Premium on bonds payable is going to be reduced by 4,500 because it says the carrying value is 1,045. So the 4,500 is the difference over the 100,000. They have a gain on bond retirement of 1,500. Where are they getting the 1,500 from? Because they have a call premium of 3,000. So think about the difference between the 3,000 and the 4,500. There is your gain. And then they're going to credit cash because they're paying out money in the amount of 103,000. All right, so that kind of takes care of the bond stuff. So let's kind of pivot now to long-term notes payable, which again, anytime you hear the word note, it's just a banking term. It just means a loan. So the company is basically going to get cash from the lender, and the question is, when is the repayment of the principal and interest going to be made? So let's take a look at an example of installment notes. So installment notes are probably the loans you're familiar with, right? If you've ever gotten a loan, you had to make those monthly payments. That's what they mean by installment notes. The reason they say that is because some companies, we don't really do that like individually, but some companies will get loans where they can just pay off a lump sum at the end. With the interest accruing all the way through, they just pay the interest at the end as part of that lump sum payment. So on January 1st, 2021, FogHog, interesting name, borrows 60,000 from a bank to purchase equipment. It signs an 8% installment note requiring 3 annual payments of principal plus interest. So the first thing they'll do is the company is going to debit cash because they're receiving money from the bank, 60,000. So they're going to debit or increase cash by 60. And then they're also going to credit the liability account notes payable to increase that because obviously they have to pay that back. Now, notice on January 1, there's no mention here of any interest, nor should there be, because interest accrues over time. It really kind of compounds daily. But the reason there's nothing on this day, so think of like the day they took out the loan, January 1 is like day 0. Any number times 0, we know is 0. And then like as of the next day, then that would be like day 1, then they would start accruing the interest. So we would compute the periodic payment by dividing the face amount of the note by what we call the present value factor. So that's if you're an accounting major, that's certainly something you will learn more about. I don't want to get into that too much in this class. But but it really speaks to what's called the time value of money. You can look up YouTube videos on time value of money. I think I've got some on my channel that talk about this idea that, a dollar today is worth more than a dollar tomorrow, because if you get it today, you can invest it and make it worth more. That's kind of the whole like overarching underlying principle of TVM, time value of money. All right, I think yeah, there we go. So installment notes with equal payments. So if installment notes, which they typically are equal payments, like if you've had a car payment, you'll know it was the same amount every month, like overall. What changed was the principal and interest. It's what we call the amortization. So if we look at an example, um, what I really want you, I'm not as worried here about you necessarily knowing these numbers, but I just want you to see how these change because it's really good to know this. If you notice in 2021, look at what's happening to the interest expense compared to 2022 and 2023. It's going down, right? And then what's happening to notes payable? Not a lot got paid off in 2021. Um, a whole lot more got paid off in 2022, and again, a lot more got paid off in 2023. And that's kind of a pattern with loans. It's when you first take out a loan, you're paying a lot of interest and not much principal, which is just how much are you lowering the actual loan amount by. As you work your way through a loan, that changes. The interest goes down and the principal payment goes up. So bear that in mind if you ever think about refinancing a loan, because a lot of people have called me, like students, friends, and like, hey, Dr. S, like I'm thinking about refinancing a loan. Is that a good idea? The answer is typically, the first question is, how far through the loan are you? Because if you're towards the end of the loan, you're pretty much at that point paying nothing but principal. You've pretty much paid all the interest in the early part of the loan. So sometimes, banks will send you stuff and they'll say, "Oh, you're a great candidate to refinance." They want you to refinance and they'll give you a lower rate, but the problem is that whole amortization resets itself and then you're going back to paying nothing but or pretty much nothing but interest again. So you end up with a lower rate and you end up paying more overall. All right, mortgages. So you've probably heard of a mortgage. It might sound strange that companies have these too, but they do. A mortgage is a legal agreement that helps protect the lender if the borrower fails to make the required payments. Right. So just like with us, if you don't pay your mortgage payment, you get some notices, you get some warnings, and then they'll foreclose and kick you out. So it gives the lender the right to be paid out of the cash proceeds from the sale of the borrower's assets, specifically identified in the mortgage contract, which of course would be the building. So features of bonds and notes. So they could be secured or unsecured. If they're secured, they'll typically have a lower interest rate because then it's less risk. They could be convertible and callable. So a lot of times, like bonds can be converted into the same amount of stock. They could be callable, which means the company can think of it like they can call you up and say, "Hey, we're basically we're going to make you surrender that bond," and then of course you lose it. If they do that, you lose out on the future interest payments. They could be term or serial. They could be registered or bearers. Like bearer bonds, if it's registered, it's to you. If it's a bearer, then whoever is the bearer, like basically the owner of the bond at the time, is who will get the interest. All right, debt to equity ratio. This is a good one to know. Just basically the total liabilities or total debt, you could say, over their total equity. So this ratio helps investors assess the risk of a company's financing structure. So the higher this ratio, then the more risky the company is because the more debt they have. So like if we look at Nike, you can see that 2 years ago it was 0.87. 1 year ago it was 1.3. Current year 1.62. So that is kind of risky, right? Because that means that they have like if we look at the 1.62, their current year, then that's saying for every dollar of equity they have a dollar 62 of debt. If we look at Under Armour, theirs is also going up. Again, 1.25. So again, for every dollar of debt, for every dollar of equity that Under Armour they have a dollar 25 of debt. Okay, that's it for this video, and I will see you in a future video.